Thank you, Roland, and thank you everyone for attending. This is our first shares webinar, so we hope it goes well. I'll try and keep this to about 15 minutes, and then, as Roland said, our CFO, Mark Lemont, is here as well as myself to take any questions after the presentation. I draw your attention to our disclaimer, which is available online and you can read at your leisure. So Caledonia Mining, we've been a friend of shares for some time. We've done several of these presentations, and it's great to come back and give updates of the progress we're making. So three key components to our investment case. First of all, we're building a very solid foundation. We have a business that's in great shape with a solid balance sheet and delivering near-term low-risk growth, obviously helped by the gold price at the moment, but we've been investing very heavily in this business for some time, and we're getting towards the end of that investment, and that's where the growth will be delivered from. And then lastly, we're operating in our view, one of the most attractive gold frontiers in Africa. This is a region that used to produce, I think used to be third in terms of gold production behind Africa, behind South Africa and Ghana. So a very attractive region, and we believe it hasn't had its fair level of exploration for quite some time, and we feel well placed to take advantage of that opportunity. So a little bit about the business. We're a Jersey-based company. We're listed on the New York Stock Exchange, the Toronto Exchange, and on the AIM in London. As I said before, fairly well cashed up, about $14 million in the bank, very little debt, about $1 million of debt, mainly working capital facilities at a mine level, no term debt. In terms of the scale of our business, we're approximately a 55,000 ounce producer at the moment. Well, as I said, we are investing quite heavily, so production guidance for future years, 2021 and 2022, we'll be ramping up that production quite substantially. And also from a cost level, getting our costs down to between $700 and $800 all in. We have a fairly substantial resource base, about 1.9 million ounces, sorry, 1.8 million ounces total resource base that supports a 14-year mine life out to 2034 with significant exploration potential. Now the mine's 114 years old. It's a very deep ore body, and the resource keeps going. We're certainly not resource constrained. And we pay a dividend. Dividend's currently 7.5 US cents a quarter. The yield's about just below, about 2.3%. Yields dropped very substantially because the share price has risen, and the payout ratio of that dividend is very low. So I'll talk more about our view on the dividend later on. Just a few key operating metrics to give you a sense of the business. The two numbers I draw your attention to here are operating cash flow and capital investment. So this is a business that's generated approximately $20 million a year. Every year, that's after-tax operating cash flow out of our cash flow statement for several years now. But simultaneously, we have been investing very heavily in the business. So capital investment has also averaged approximately $20 million a year. So most of that the investment's been funded from cash flow, but we're getting to the end of that capital investment phase. So we're essentially building a new mine underneath the current mine, and I'll talk you through the details of that. But that's the key to the investment case. We're getting to, in 2020 now is the last year of heavy lifting capital investment. So we'll see this capital investment tail off in years 2021 and beyond. And equally importantly, we'll see the fruits of that investment start to be delivered, where our production will ramp up from about 55,000 ounces up to 80,000 ounces over time. And that we expect to get a substantial increase in operating cash flow. So both of these lines are moving in the right direction for shareholders. We've had a string of good news. Our share prices responded accordingly, but we've had a good year of positive results. I won't go through all of those in detail. Those of you who follow our business will have seen that. But we completed the sinking phase of the shaft where all the investment's been going in Zimbabwe. Very good production figures, increased earnings guidance for 2019. And then most recently, the announcement of a dividend for the second quarter of 2020, which, given the coronavirus, we had some uncertainty around the dividend, and the board of directors have decided last week that the business was in sufficiently healthy shape to continue paying that dividend, and obviously that's good news for shareholders. This is our capital structure. Again, investors can view this information pretty much at their leisure. Market cap's about $150 million. Share price is actually reaching pretty close to all-time highs. I think we just passed £10 in London and $13 in the US. We benchmark ourselves against the GDXJ, and that's been quite a healthy outperformance over time. Most of this outperformance comes from the dividend. So, you know, back in several years ago, this dividend was about 10%, and when you compound those over time, that's quite a healthy return. This is our reserves and resources. Again, a very nice chart. We certainly don't feel resource constrained as a business. Our discovery cost of gold at this asset's about $4.40 an ounce since 2013. Just shy of 1.8 million ounces. About half of that is measured and indicated. The other half is inferred. I'll talk about that later, but this is a vertical ore body, keeps going deeper and deeper. We haven't found the bottom of any of the structures yet, but we are constrained from a drilling perspective in terms of how deep we can drill from surface. And so therefore we do depend on underground development and the shaft project to continue drilling so we can delineate this inferred resource and so we can continue to find new resources. We have, I mentioned the dividend already. We announced last week that the dividend for Q2 would be paid. We have a long-standing commitment to paying dividends. It's very important to shareholders. That's the feedback we get consistently at meetings like this and from some of our institutional holders. You can see there just a long track record of paying dividends. We increased the dividend earlier this year as the cash flow of the business improves and as the situation with the central shaft project being close to delivery, and we expect to be able to increase that dividend more so in the future. So this is really the key to the investment case, that we're building a new mine underneath the current mine. There's a brand new shaft going down. It's one of the largest mining investment projects, or one of the largest gold mining projects in Zimbabwe. It's transformational for our business, and it's going to be completed in Q4 of this year and ramping up over the next 18 months or so. I'll move on to a bit of a diagram which will give investors a bit more color in terms of what the shaft actually looks like. This is a long section of the mine. So what you're looking at here from left to right is about a 3-kilometer strike, or the different ore bodies we extract, and then about 1.5 kilometers total depth. So and you can see the gray areas are the mined out areas of the mine, and then the colored sections of the deposit give you the different ore bodies and different levels of geological confidence. The 750 meter level is quite key. This is the existing infrastructure is constrained at 750 meters. When we bought this mine from Kinross in 2006, there was an existing shaft in place, which is our main production shaft, which is the 4 shaft. Again, this stuff is not to scale, but it gives you schematically an area of the infrastructure we've been operating for the last 14 years. And it's constrained at 750 meters. So there's plenty more resources at depth in all of these ore bodies, and lots of exploration potential below here, but we need to go deeper in order to see that. This is the Jethro shaft. That's where our people come down. So the men currently come down here, they walk across, they come down another shaft underground, and then potentially walk 2 kilometers to get across to mine at various different sections, and then all of the ore is trammed back on 22 level, which is 750 meters, and hoisted up at surface to surface. This is not how you would build a mine if you were building it from scratch, right? You can see, first of all, things are on the wrong side of the operation, so everything's one side and you're mining from one direction. Also, there's a long sort of labyrinthine level of tunnels that people have to keep heading through. That is the central shaft. So it comes down the center of the mine, as the name would suggest, and it allows us to operate 3 new operating levels down to 1.2 kilometers, and the potential to operate declines if we need to go deeper. It opens up drilling access so we can delineate much of the inferred resource here, and to continue drilling at some of these deeper sections to find greater resources at these continuations. It's a much bigger shaft. It hoists men, materials, and rock all at once. You can mine from both sides. It gets the men to the working face in about 20 minutes versus currently it can take hours for people to get to the face. It's a very exciting project. When we switch this shaft on, which will be Q4 this year, it's going to be transformational for our business, and we're quite excited about that. This is just some pictures of what we took, and the reason I put these in is, people often think we're operating a mine in the southern tip of Africa. This is a mine that would stand back to nowhere anywhere else in the world. I've seen mines in Canada and Australia, and it's certainly up there in terms of scale. These are 3 meter by 3 meter tunnels. We completed the shaft sinking, and we're currently in the equipping phase. And like I say, the inflection point for the business is Q4 this year. This is really the key to the investment case of the business. Now, this slide is a little complicated. I'll spend a bit of time explaining it. This is our cash flow statement represented in graphical form. The historic data is actual data out of our cash flow and CapEx Australia. If you looked at our cash flow statement, you would see these numbers, and these are the same numbers I highlighted, brought to your attention on the first slide. The light grey bars are operating cash flow after tax, and the dark grey bars are capital. And you can see over the last 5 years we've been investing very heavily in this project, and the cash flow generated by the business has pretty much paid for the CapEx. So this has all come from operating cash flow. We haven't asked our shareholders for money to fund this project. 2020 is our production budget at $1,600 an ounce. So you can pick your gold price going forward, but looking at our production budget 2020, if this gold price holds, we should have a fairly good year. But you can see that from a free cash flow point of view, there hasn't been a lot of free cash flow left over for investors. And that situation is about to change in Q4 of this year as we switch the shaft on. And two things happen as we head into the new, starting to operate from central shaft and no longer operating from fore shaft. Firstly, production ramps up from 55,000 ounces to 80,000 ounces. That will increase operating cash flow. And then secondly, and probably equally importantly, is CapEx starts tailing off. Now, the data that you're seeing here is for our M&R resources only, and for regulatory purposes, we do not display production from inferred resources. So you can see the incremental free cash flow that we start generating as we mine from M&R resources in this mine plan. It's important to highlight we've got almost 1 million ounces of inferred resources. That inferred grade is 4.5 grams, and our current mine grade is about 3.3 grams. So the inferred grade is high grade. We don't have inferred resources that are not mineable. The only reason they're in inferred resources is because we haven't been able to drill them to the sufficient level of drilling accuracy with the infrastructure we have at the moment. So we have full confidence that as time continues, we would expect to see with additional drilling access and additional drilling capacity, we would expect to delineate that inferred resource and continue this level of production and this level of free cash flow, very importantly, from the inferred resources that we'd be able to drill through and include into the mine plan. So this is done at a gold price of $1,214 an ounce. So importantly, you can pick your own gold price there. But if these gold prices hold, this is where the maths for investors gets quite easy. We've got 80,000 ounces, about an operating margin of $1,000 an ounce. That's $80 million of EBITDA at after taxes and minority interest. We can see probably quite comfortably $40 to $50 million of free cash flow for the business. And then the question is what we do with that money. We do believe, as I said earlier, we're operating in one of the last gold frontiers in Africa. This is an attractive region. What you're looking at here is a map of Zimbabwe. That greenstone trend there is about the size of Burkina Faso. So this is a major region that behind Ghana and South Africa used to be number 3. All of that gold is still in the ground. We're down here in the southern area, but there's several very attractive brownfield opportunities that we see, mostly old mines that were shut down in the 60s that need capital, need expertise, and frankly, we believe a unique competitive advantage in the country in one of the most attractive gold mining regions in Africa. So we're very excited about these opportunities. I would say it's fair to say we'd be probably disappointed if we weren't a multi-asset company in Zimbabwe within the next year to 18 months. The criteria we use to evaluate these investment opportunities in Zimbabwe, we're not in the business of buying large producing assets that need substantial levels of restoration and investment, and we're not in the business of looking at substantial acquisition cost. So we're looking at things that we could probably acquire for a few $1 million, spend a few $1 million exploring, and then take a view as to whether there was a resource that was worth developing, and at the same time simultaneously growing the dividend for shareholders, so that we would be in a position to reward shareholders for their patience over the last few years. Zimbabwe, I'm sure there are going to be questions on, so I'll go through this quite quickly. But we do see grounds for optimism. The region is challenging, but we've got since 2006, we've got 14 years of operating history there. We've been paying a dividend since 2012. All of that comes from the mine in Zimbabwe. So we certainly think it represents mispriced risk from an African perspective, and in our view, mispriced risk is where investors can make some money. So that's a quick summary. I think we've left a bit of time for questions. Hopefully, we have a good track record. We're a solid operator in country. We have very low risk and fully funded production growth that just comes from the central shaft, where the mining method will be exactly the same. It's just new infrastructure and a new shaft. We have a pretty good dividend yield, and the payout ratio is below 20% of 2019 operating cash flow. So you can do the maths for yourself, but the dividend cost us $3 million. So with those free cash flow numbers we're talking about going forward, we're in a position to grow this dividend very, very substantially. And we're in one of the last gold frontiers in Africa. So that's all from me from a presentation point of view. I don't know if we have any questions.
And as you'll be able to see on your screen, we're now joined by Mark Learmonth, who is CFO at Caledonia, so we can take on any kind of money questions. So we have had a few questions coming in, and so no particular order. You mentioned Zimbabwe country risk. It's probably a question you get asked a lot about the risk of nationalisation or being seized by the government. Can you just talk to that just for a second to kind of clear that away?
Sorry, can you hear me?
Yeah, we can hear you.
I think we've demonstrated earlier on this year that risk is now going the other way, in that we rolled back part of the indigenization. In January, we bought back a further 15% of Blanket Mine that was owned by local parties, and we were approaching government to buy a further 16%. So we will certainly keep the workers in at 10% and the community in at 10%. But what's become very clear to us over the course of the last certainly this COVID-19 period, where government is now increasingly desperate for foreign exchange and for tax revenues, is there's a very clear understanding in government that they just haven't got the skill set to run a mine as complex as Blanket Mine. So we do not see that as a significant risk.
Thank you, Mark. And you mentioned COVID-19. We've had a question about how that affects the working day. Do you experience staff shortages?
No,
social distancing?
Very little. So Blanket Mine is a very self-contained operation. It's about 16 kilometers from the nearest town, and we've got about 1,500 workers who live on a mine village with a wife and family. So there's about 5,500 people living on the mine village. It's surrounded by security fences. We've controlled access and exit from the mine so that we can stop contamination coming in and out of the mine. Frankly, but it's got to be said, there's very little incidence of coronavirus in the region. We have about 60 workers who live out of the mine in the local town. They've not been able to get into the mine property, but that's really not caused us any difficulty at all. And so during the 3-week lockdown in Zimbabwe, which had now been extended by a further 2 weeks, we did get permission to continue operation from the Zimbabwe government, and we achieved about 93% of our target production in that lockdown period. So, and the reason why it was 93% and not 100% is we had to engage in some forms of social distancing. So we're not having any appreciable effect on the business as a result of coronavirus, and that's why we're able to reverse that decision to defer the dividend. So when we went into this lockdown, we just didn't know what was going to happen to the business at all. And so on that basis, we thought on the grounds of prudence just to defer the dividend decision. Having been through that sort of a 3-week period, we can see the effect was negligible, and so therefore in a position to continue to pay the dividend.
Yeah, that's my key question about the discussion about paying the dividend. What were the key factors, the main criteria when deciding to kind of keep on paying?
The main criteria are quite simple. First of all, we had to have workers who were fit and able to turn up to work, and so we were concerned. We had no idea to what extent our workers might fall ill, and that's still a risk going forward. So first of all, we need to be able to produce the gold, and the key element to that is that we need workers who are fit and healthy and able to turn up and work. Second thing is that in the context of a shutdown in South Africa and a shutdown in Zimbabwe, pretty much everything the mine uses is purchased in South Africa and trucked up to the mine. And if the borders are closed, that means we just simply can't move stuff. Now, one of the benefits of working in a place like Zimbabwe is we don't operate just in time. We don't operate on a just-in-time basis. So we do run quite large stocks of pretty much everything. The constraining factor, though, is there's a regulatory restriction on how much explosives you can hold. So at any one time, I think the most explosives we can hold is pretty much for 5 weeks, and 5 weeks typically covers us for a 3-week shutdown, and then an extra 2 weeks to get the supply chain working again. So we need our workers fit and healthy. We need a supply of raw materials and/or using our stocks. And then the third thing is that we need to get paid if we're going to continue to deliver gold. If the government is anxious and desperate for money, there must be a temptation on the behalf of government to defer paying us. And if we're not going to get paid gold, we're not going to continue to deliver gold. But we've had absolutely no difficulty on that front at all. And in fact, actually, the government appears to be behaving itself extremely well in terms of making payments promptly and in full. So those are the 3 real criteria: the health of the workers, access to raw materials, and just continued ability to function, getting access to market for our gold. Those are the three main criteria.
You mentioned the workers. We've actually had quite a few questions about community support and kind of welfare amongst workers, and ensuring you keep the kind of community buy-in, I guess, and people being treated fairly. Can you talk for a moment about that, please?
Yeah, we late last year we've always done well. The community owned 10% of the mine. Let's be clear about that. So they're 10% shareholders in the mine, and they've received $4 million of upfront dividends, and they also received $1 million donation. So the community has received money from the mining operation. Late last year, we've always run a very informal CSR operation, but just informal. But recognizing the sort of the run of play amongst investors to see much more transparency in terms of corporate and social investment, we formulated a formal CSR policy late last year, which is actually available on our website. And in our upcoming quarterly report, which we'll be publishing next week, we'll go into some detail as to the projects that we're engaged in with the local community over and above their share ownership, their share participation in the mine itself. In terms of supporting the COVID-19 sort of campaign, we've made significant payments both through the Chamber of Mines and directly to needy projects in our area, and we've committed to make further payments of about $200,000 a week to continue to support that. So we feel actually we're paying more to support the fight against coronavirus than we're paying in dividends, and I think that's a point that's well worth making.
And the other questions had a lot of people asking is about taking money out of country, and how does that work, currency, and any restrictions about taking money out?
It's actually improved enormously. The critical criteria is that we generate foreign exchange. We make money, and if you're making money and you're making surplus money after after having paid your costs and paid your capital input costs. If you got surplus dollars left over, you can get it out of the money, get it out of the country. I received just $2 million this morning out of Zimbabwe, and we've actually found the process of extracting cash from Zimbabwe has improved quite significantly since late last year, and that really is a factor that the mine is now generating much more money as a result of higher production and a higher gold price. So we get money out through 4 ways. There's a management fee, a monthly management fee that goes to Johannesburg for the services that Johannesburg provides to the mine. We get a procurement margin. Pretty much everything the mine uses, we buy in South Africa, and so there's a typical markup on all that sort of stuff. We extract dividends from Zimbabwe, and we get loan repayments from the indigenous Zimbabwean shareholders. So I know many companies do struggle to get money out of the country. It's something that we've never had a difficulty with, and the proof of the pudding is that pays money from Zimbabwe, pays for our participation in stuff like this. It pays for our dividend. It pays my salary. We've got no other source of funds apart from Zimbabwe. The fact we've continued to pay a dividend now for many years, I think should give people comfort that we're able to get the money out of the country.
Lovely. I think on that note, I think for timing purposes, I think we're done. So Maurice and Mark, thank you both very much indeed for joining us this evening.